Hello everybody, this is Argentus Maximus and I'd like to welcome you, and we have a very interesting gold enthusiast here to have a conversation with today. He is a private person, not a member of the industry or a paid reporter or journalist, and therefore he'd like to remain anonymous. We will call him Paul. And we also would like you to see his YouTube presence. Paul produces videos on the price of gold and other interesting hard asset matters at the YouTube channel Belangp. That's Belangp. So let's get straight to the matter. I'd like to welcome Paul, and we'll see where the conversation goes. Hello, Paul.
Hello. I'm doing well, thank you. How are you?
Very good, thanks. Paul, can we, for the benefit of the people listening to the podcast, can you introduce yourself and tell us something about your specialty and your line of research into the world of gold?
Sure. I've been a gold investor for the past 15 years, and it's gotten me to study a lot of monetary history and history in general. I found that's a very rich area that's quite different from my chosen profession. But in the past year, I've decided to put some videos together to kind of educate people about some of the things that I've been fortunate enough to learn through my journey of investing in the metals. And so I guess that's how we came to meet.
Well, the main reason why I brought you here, Paul, is because I've seen your videos on YouTube, and to be honest, they're quite outstanding. You have managed to combine a great clarity and a great conciseness, and at the same time cover very interesting subjects to do with the price of gold. Now, I recommend Paul videos wholeheartedly to listeners. Now, before we got started, we had an interesting conversation about gold and the petrodollar. So maybe that's a good place for us to begin. Would you like to tell the listeners your views on the petrodollar and gold?
Well, let me just take 5 minutes or so to introduce everybody to the basic gist of the subject matter of my videos, and then maybe we could take it from there. Sound good?
Please do, yeah.
Okay. Well, in order to really understand and comprehend the evolution of our monetary system over the past century and where we may be heading, one must understand the relationship between credit and economic growth. When growth in an economy is possible, but it requires much capital investment, it's necessary for credit to expand. And credit, in order to be sound, requires that the economy expands as expected in such a way that the credit can be paid back. But this leads us to two potential problems that we've been experiencing over the past century. The first type of problem results from a credit system that's not designed to grow with the overall economy, but is forced to do so. The second type results from an overextension of credit that is unjustified by the prospects for economic growth. In the late 19th century and early 20th century, we had a special economic event. It was really when crude oil was just starting to become available as a primary source of energy. And the growth potential from this fuel was tremendous, and many wanted to unlock this potential. But the trouble was that it required tremendous capital investment, and thus it required a rapid expansion of credit. And this credit was expanded fairly rapidly. In fact, if you take a look at data from 1910 to 1970, you'll see that the growth rate in oil production was 7% per year, and credit creation more or less matched this rate of growth. In fact, it grew at 6.9% per year. But this put tremendous stress on the system. Why? Well, the economy grew sufficiently to pay back the credit in real terms, but the credit was denominated in an instrument which was tethered to gold. Gold, because of its nature, only grew at 1.9% per year. It's quite difficult to mine new gold. And because gold's price was fixed by edict, it became impossible for all commitments to be honored, despite the growth in the real economy. And so we had two milestone defaults in the gold-based dollar system. The first we know very well was in 1933 when FDR closed the banks and called in the gold. The second was in 1971 when Nixon closed the gold window. Now, the default in 1971 was much more significant than the default in 1933 because the explicit promise to pay a fixed quantity of gold in return for dollars was replaced with an implicit promise to keep the dollar strong in gold. In fact, in 1973, there was a documented meeting between Henry Kissinger and Saudi Arabia where he convinced the Saudis to push for OPEC to accept only dollars in exchange for their oil. And this was the birth of the petrodollar system. As long as OPEC required dollars in settlement, there would be a market demand for dollars. But what was in it for Saudi Arabia? Well, first, they have enjoyed some level of influence over how the U.S. has used its military in the Middle East. But more importantly, for our discussion, they were promised by the U.S. that they could take their excess profits and buy a certain amount of gold. Now, this arrangement in the 70s was new, and it was severely tested. In 1973, the Shah of Iran raised oil prices significantly. This severely stressed the U.S. economy and at the same time created a tremendous flood of dollars to the oil states of OPEC. The IMF needed to establish an oil facility for managing the international banking, managing the recycling of all these petrodollars. And a group of 10 countries also met in Basel, Switzerland to forge an international banking agreement to manage a potential sudden withdrawal of petrodollars from the banking system. And by the way, this was when LIBOR was born. A few years passed without incident, but then the Ayatollah Khomeini rose to power and he shut off the Iranian oil exports. The world had to turn their attention to the Rotterdam market for oil supply, and as a result, the price of oil skyrocketed. The gold market, which was primarily physical at the time, took off with the price of oil because the oil states were bidding directly for physical gold with their oil money. And right around 1980, the wheels were about ready to fall off the bus when things suddenly turned around. Most people credit the rise in interest rates by Fed Chairman Volcker as the reason why the dollar regained its strength. But I think there were a couple of other reasons. For one, Iraq invaded Iran with the full backing of the U.S. But secondly, a new gold derivative system was born. It was the former that helped to unlock the oil availability from Iran, but it was the second that provided OPEC a way to obtain their desired gold without directly bidding for the physical. So this new gold system works pretty well to satisfy multiple interests. I can't go into too much detail here, but basically the way it works is that the mines need cash for funding their operations. And so they take out gold loans from the bullion banks. The mines get cash to operate in return for short futures contracts to deliver gold at some future date. The bullion banks then sell the short futures contracts to someone who's interested in taking a long position. This is one of the primary ways that bullion banks make profit. Some of their customers, especially the oil interests, have the intention of taking future delivery. So what would interest them in a long futures contract instead of spot gold in the present? Well, part of the reason is that they know that they can't bid for physical gold directly without running the price. They learned that lesson in the 70s. The second reason is that central banks provide the backing for the gold loans. You see, they have lease agreements with the bullion banks that allow the bullion banks to mobilize the gold short term in the event that the mines can't deliver against their shorts. In this way, the gold loan creates a paper instrument that behaves very much like a dollar-backed currency of the past. And so the bullion banks make money, the mines get their funding, the oil states get their gold, and the world's central powers ensure that oil will continue to flow. Everybody wins. But what could cause this new system to fail? Well, we've already discussed the need for the economy to keep up with the expansion of credit. But what if it doesn't? Since 1970, world credit continued to expand at a rapid pace. In fact, credit growth over the past 40 years increased to 9% from 7%. Meanwhile, the growth rate in world oil production has actually been in decline. If you look at the data, from 1970 to 2000, oil production grew by only 1.3% per year. And from 2000 to the present day, it's hardly grown at all. In fact, it's declined slightly. In a world that's powered by fossil fuels, it's impossible to create real growth without increasing energy consumption. So for the past 45 years, we've had a tremendous mismatch in the growth in credit and the growth rate of output of real goods and services. And this is credit that cannot possibly be repaid in real terms. Either the currency will need to be inflated away gradually or suddenly, or the debts will need to be defaulted on outright. The big problem that this is going to create for the world is that many people treat these credit instruments as their savings. They assume that they'll have purchasing power in the future, while the mathematics of the situation dictate that they can't. There are about $1 quadrillion worth of perceived wealth out there in the form of credit instruments when you include derivatives. And many of the world's super wealthy already realize that there's a problem, and they're trying very hard to quietly obtain as much tangible wealth as they can in return for their existing paper wealth. Yeah. In other words, you're seeing the very wealthy pass this hot potato along right now, and currently it's the Federal Reserve that's accepting this hot potato in return for cash, which is then used to buy land, buildings, artwork, gold, etc. But they won't be able to convert all of their paper into gold. Eventually the debt is going to have to be written down, and when it is written down, it's going to have to be written down by quite a bit to compensate for the tremendous mismatch between credit growth and the growth in real productive capacity over the past 45 years. And when this happens, the elite of the world are going to need a way to ensure that they stay the elite, aren't they? Yeah. So how can they accomplish this? Well, gold is the obvious answer. Due to years of gold derivatives contracts use, the value of gold has been artificially suppressed. Remember, in the physical-only world, the gold is very tightly held and not available at commodity-like prices. But the presence of the gold derivatives market has made new gold much more available than it otherwise would have been. And this has put tremendous downward pressure on the price of gold compared to what it would have been had the run in the late 70s been allowed to continue itself.
It has probably also increased the total volume of gold which was perceived as existing.
That's correct. It's not only the perceived volume, but more importantly the velocity of gold. Most gold lays stagnant, but when you have these derivatives contracts, you can actually increase the volume of transactions between a few small sellers on the margin without the large stocks ever having to move. But but really, when you look at it, all the elite of the world need to do is to stop their support of the paper gold market, and the price will adjust itself upwards naturally. And at some point, they may even use their influence with the governments of the world to create a new currency that will act to boost the value of gold. And one way this can be made to work is to introduce a new currency along with a new minimum wage, for example, and a new set of tax laws. Then they could offer to purchase any amount of gold a seller wished to offer at a given rate. This would create a floor under gold's price at a desired level, because if the actual value of gold fell under that paper price, people would simply turn it in exchange for a certain number of units of the new currency. Now, this would be a very different type of system than a gold exchange standard of the past, because while the purchase of gold would be mandatory for the Treasury would not be required to exchange gold for the currency in return. But it would achieve the goal of elevating gold's value to a new permanent plateau. Of course, it would take a very high price of gold to fulfill its role as the wealth reserve asset of the world and make up for the loss in value of all these credit instruments. I estimate a real value that's currently about 30 to 40 times its current price. Hard to imagine? Yeah. Ridiculous? No.
Given the expansion of credit, the only debate there would be when the credit shrinks, what is left, and then that would presumably be the basis for a new valuation of hard assets. We don't know how much.
Yeah, and then that's right.
And they wanted to shrink as little as possible, of course.
Right, but gold is a little bit special because it's not like currency. When society needs more money or less money, then it requires the expansion or contraction in the paper money supply. Gold's a little bit different. It changes in price instead of in volume. And gold is one of the only items on the planet that can really assume any value relative to everyday goods and services. It can assume as high a value as necessary to accommodate this new system. And this is because it's not consumed in great quantity. There are very few industries that would suffer from a gold revaluation. Contrast that to an arbitrary price increase in the relative value of any other raw commodity that serves as a key industrial ingredient. It can go as high as society needs it to go. And this, in a nutshell, is really the concept of free gold. It's the sudden upward revaluation in gold that will be required to reconcile the imbalances of the world credit markets that will be initiated through a failure in the derivatives markets and ultimately supported by state backing. So that pretty much sums up the basic theories of a lot of the videos that I've put together.
Continuation of expansion of debt or credit, if you like, will create a new bull market in gold, or are you proposing that the FOA thesis be achieved by gold going sideways and then stepping up after the fashion that it did in the 1920s and 1940s? What do you make of that little naughty little problem?
Well, I don't think that their thesis is really played out yet. Certainly people that heeded their advice and purchased gold in the late 90s did very well currency-wise, but really I think they just ended up preserving their purchasing power. You see, ever since 1970, if you take a look at the data, you'll notice that an ounce of gold has purchased anywhere between 10 and 25 barrels of oil. And it's hovered right in between that range for a period of 45 years. It's a remarkably stable relationship. And in the late 90s, oil could have purchased only 10 barrels, or gold could have purchased only 10 barrels for an ounce. And if you take a look today, it can really only purchase about 13 barrels per ounce. And so in real terms, gold really hasn't gone anywhere. I mean, certainly we've had some exciting fits and starts and some very nice peaks, for example, in the 2006-2007 time frame and again in 2011. But for the most part, gold has only stayed stable with respect to the price of everything else.
Can I ask you there?
Yeah.
Should gold be expected to exceed the rise in the price of oil, or should it be expected to match the rise in the price of oil?
Well, it's matched the rise in the price of oil over the past 10 to 15 years. I think primarily because the oil states have raised the price of oil so that they could obtain a certain amount of gold with their excess oil profits. What's been happening is that the Chinese have really gotten in on the game, and they've started taking advantage of the mechanism that was open to the oil states.
Indeed.
For the past 10 to 20 years. That's put pressure on the derivatives markets and caused the price of gold to rise, and consequently, the price of oil has risen along with it.
Okay, yeah. In dollar purchasing power, they've both risen, but not much, not a lot, considering the rise in the credit. So you're suggesting that there's going to be a big difference take place fairly soon on that, or are you taking a kind of 25-year view?
Yeah, I don't know if it's fairly soon. I mean, people have been predicting this for the past 15 years, and it hasn't really occurred yet. I mean, the price of gold has gone up, and that's been vindicating for a lot of people who have had these theories, but gold really hasn't fulfilled its purpose yet. And it's actually quite surprising when you think about it that the economy has held together as long as it has. Every year it seems like the worm is going to turn and it's going to be imminent, and yet the economy still goes on, although we can see that the acts of the central planners seem to be getting quite a bit more desperate as time goes on.
Oh, they definitely seem to be lurching from sideshow to sideshow. There's no doubt about that.
Yeah.
These warlike ventures definitely do seem to be related to periods of economic stress upon the leadership. But now we're moving towards a situation where the leadership is becoming a global leadership rather than a US hegemon or US-UK European grouping. And the times they are changing. So in the good old or the bad old days, there was a balance of power between, let's say, the Iron Curtain countries and the West. And this slowly is morphing into a balance of power between Asia and the West instead, with the ex Iron Curtain countries leaning slightly towards Asia or Europe more than towards the US. So how much this will be a two-way or a three-way situation going into the future is very difficult to say. But I think we're moving a little bit more towards looking into politics a bit too much there, and maybe we should focus more upon the pricing of gold versus the main currencies. So just trying to pick you up on 2 points and see what you say about them. You mentioned the fact that there was a default in the dollar in 1933, and people are aware of that, but people tend not to think that there has been any defaults since then, and I would posit that there have been 3 defaults in the dollar, and I would say that each time afterwards it was a different dollar, just merely using the same name and the same banknotes. But in the 1890s to the 1920s, the dollar was essentially a silver article, and unfortunately the silver mines were producing rather a lot of silver, and it came to be that the silver, the money supply, ended up in the hands of those people digging it out of the ground. Some of it went to the banks, but a lot of it went to the people. At which point certain very bright bankers took the view that they'd rather something else's money, something that they had and no one else had. And they managed to inveigle the state into changing in the 1930s, changing the money from silver to gold. At that time, essentially everyone who had silver had to go and get gold to pay off their loans or their overdrafts or whatever they had. So they had to sell their silver for scrap value or for greatly depreciated value and buy gold, which the bankers owned it all. Now we move forward, and the next break that I can observe was 1968 to 1971, where there was a second break, and this is where the petrodollar was born. People tend to regard the dollar as being the same thing since the 1930s or even since the 1800s, and I would say absolutely no way, because after 1968 the dollar wasn't exchangeable for gold, and therefore gold was not the reserve currency. From the point at which France did not get their gold, and the gold they got was the last of it. I mean, there was a default in another country at the same time. Was it Switzerland? But at that time there was another country wanted their gold and they didn't get it.
I can't recall.
There definitely was. But anyway, the French got some of theirs, and after that, that was the end of it. So the temporary suspension of gold became the permanent one, and the dollar became pure paper, ostensibly. But Kissinger and Nixon actually did a blinder for the United States, and didn't exactly do a favor for the rest of the world. After that period, gold exchange for oil, exchange for dollars, via the Saudis, the US and the gold mines, with the bullion banks standing as the exchange agents, became the game, and very opaque. And here's the question: are we looking at this breaking down? And if so, what do you think is going to happen?
Well, I think it is starting to break down, and it's largely because China is breaking it. They're importing, at this point, the equivalent of all of the world's new mine supply. And so there's really not much left over for anybody else. And so those who use the paper derivatives market in order to obtain real gold are going to find out that sooner or later they will not be able to do so. And I believe what's likely to happen is that the confidence in the paper instruments is probably going to decline. And so this is what's going to cause a bifurcation in price signals. The price signal that we're actually going to get is going to be coming from the futures markets, and it's really going to be the price of a paper futures contract. Meanwhile, gold offered at spot for physical settlement, for example, on the Shanghai exchange, may have a completely different price. Now, I don't think that they're that far different at the moment. I mean, the price is the price, but sooner or later there will be a set of conflicting price signals, and the price signals that come off of the COMEX and the London Fix may not be relevant anymore for the person who wants to obtain real physical gold.
Well, at the moment we seem to have a situation where the Shanghai price or the Asian price, the premium upon that, it appears to reflect the costs of getting gold from the west to the east, plus the costs of refining it to a different purity if it's LBMA standard. But it also has a little premium on top of that, an arbitrage premium, which the bullion banks appear to be availing themselves of. At any rate, I would propose that the flow of gold out of the UK, as represented in my eyes by the reduction of the inventory of the GLD ETF, that gold going east has essentially been a confirmation to me that arbitrage of the Asian, the collecting of that premium has begun, and therefore that premium will probably never be as big in the future as it is now. It's probably on a permanently reducing basis, unless one thing happens, and that event would be the unavailability of new gold in the West, at which point presumably the price must go up. Now, right now we're in a situation where the price has gone down searching for supply, and that has forced people to liquidate their holdings in GLD, for example, and sell. So price going down has, as they use the phrase, freed up gold from its previous owners. Now, we are obviously at this juncture in time where if price going down does not release more gold, and if the demand in Asia continues, then price will have to rise in order to release gold. Now, that generally applies very well with other assets. Something goes up in price and people sell it. But in actual fact, gold is one of these strange goods that when price rises, some people sell it, but other people begin to buy it. And we can get into economic theory here or not. I prefer we don't, really. But the question is, will another leg down in the price of gold release more gold or not? We certainly saw a great amount of demand created when the last leg down in April in 2013 it produced a very interesting change in terms of the demand for gold in the East. Now, I don't think that was actually covered very well by Western media, and certainly we could move into the psychological presentation of the gold market if we want. I don't know if that's productive either, other than to observe that I have my doubts whenever I see something in the media, especially to do with buying or selling gold, and I wonder if that black market coverage has actually been arranged. So when I see people buying gold rapidly in China, I have mixed feelings. One is the arbitrage, west to east, gold flowing east, demand is over in the east. And the other feeling is, why am I looking at these pictures? Have they been kind of encouraged to get to me in order to make me buy gold because central banks are still unloading and want a good price? You know, the double think kicks in. What do you think about that?
Well, I don't think that the Western powers that be want people to buy gold. And many would claim that that's because it's a competition for the currency. I think there's actually a deeper reason for that. And that is that gold needs to flow to a certain group of people, primarily those who could, if they wanted to, decide to price their oil in gold and not accept paper currency.
Energy producers and energy sellers. Always has been the case.
That's right. Sure. And so, the central powers have to make sure that these consumers are satisfied. And there's a very different set of thinking between the Western mind and the Eastern mind. You see, in the West, we're conditioned to think that if the price of something is falling, it's an undesirable thing to hold. And so over the past few years, we had a bit of a problem that people in the West were actually starting to pay attention to gold because its price was rising so quickly. And I believe one of the reasons why the GLD, for example, was created was to create a mechanism where a paper market could absorb some of the buying pressure that was being created from these Western buyers. And there are other instruments as well that can do that. Now, as the price was rising, of course, we had people in the East who were purchasing gold. We had people in the West who were purchasing more gold. Some were purchasing paper, some were purchasing physical. And it was running the risk of disrupting the supply of gold to the energy producers who require that in order to keep the oil flowing. And so I believe what we had was an orchestrated campaign to try to cause the price to go down. And of course, the Western thinkers and hedge funds, they see the price starting to go down, and they are weak hands because they only follow a trend, and so the weak hands basically did the rest of the work. Right now we're facing a bit of an opposite extreme, and that is that the mines themselves are under tremendous pressure because now their profit margins have essentially gone down to zero. I mean, if you take a look at the stock price of most of the mining companies, it's back at levels that we haven't seen for a very long time, not since the late 90s.
There's an interesting angle there, which is that the indebtedness of governments is almost a 100% certain forecast of higher energy costs when tax has been added for the coming decade. It's really a one-way trip. The stagflation, which is produced by trying to devalue the debts and repay them and pay for bloated government the world over, I'm not talking about any one country here, virtually guarantees higher energy costs for gold mines. Now, in those circumstances, producing below cost is, let's say, it's a long-term limiting factor.
Yeah, that's right.
Now, there is also a certain cyclical point which I'd mention here, which is that whenever you have these big stagflations and slowly the fiat currencies of the large countries are devaluing, particularly in times of no growth, and that's why I said stagflation. So you have inflation in the devaluation of the currency, but you've also got the twin-pronged depressionary background. We can look back, say, for instance, at the 1970s, and we can say that while the people stuck it out and really had no choice, they lost their wealth. They worked for fixed wages during a period where costs were rising, and most of those costs were due to government imposed taxation or charges or interest devaluation or something. But during those periods, energy producers who are sovereigns tend to not get bullied around as easily as a nation's own people. And at some point the energy producers get a bit, let's use the phrase antsy, and they get a bit cheesed off, and they sort of say, well, if you're going to pay everyone else in this crappy old paper money, that's all very well for them, but not very well for us. So there tends to be an energy crisis during these stagflationary periods. And in actual fact, in many cases, it has been discovery of new energy which bailed out the indebted governments. For instance, I'm thinking, for example, of North Sea oil saving the British government of the 1970s, 1980s stagflation. But that didn't stop. The North Sea oil, by the way, was too expensive to dig out. The technology was too expensive until after the inflation. And when the currency had gone down and the oil had gone up in price, that allowed them to pay the costs of getting the new oil out of the ground, which paid off their debts. So there is a sort of like a fixed mechanism which kicks in during these periods, whereby energy has to rise in price in order to get the sovereigns higher tax on retail sales. That produces a situation where the next domino falls, which is the energy producing countries saying, hey, we've had enough, and rising their prices. And that tends to produce the monetary crisis, which Paul Volcker came along in. Now, a lot of people say Paul Volcker sort of ended the gold bull, and he ended the silver bull, and he did this to save the hunts. I would propose a more basic interpretation of what Volcker did. Volcker was confronted with a collapsing bond market, and the American government needed to borrow more money. And I would say Volcker did exactly what he had to do. you know. So like the room for genius in Volcker's decisions, to my mind, is you know, I put him in the box of someone who came in, saw a disastrous situation, and took the only option available. And I'm waiting for when that happens in the coming years. But in all of those circumstances, the energy crisis triggered the next phase. And gold, of course, is intricately linked in the pricing of the energy. So at the moment we have the sovereigns making a huge changeover to natural gas. And this is really them clutching at straws because of the rising price of oil. And we also, as the change to natural gas is being made, we see this situation whereby the Saudis are a little bit less popular with the West, and all these wars in the Middle East are kicking into action, and they just happen to be places where there's natural gas. I mean, Cyprus, the bank takeover, you know, not that far from the Cypriot Turkish gas fields. Israel and the decreasing political relationship with the Obama regime. Well, Israel is now a natural gas producer. So this petrodollar thesis of yours intrigues me here, because I do believe in the future it's going to be a natural gas petrodollar, or when the dollar's gone, dollar replacement. And I'm fascinated with what will happen to gold as the energy cost of the inflationary side of the pie comes home to roost. It surely must fit in with higher values for gold. I can't see any other way. But what do you think of that?
Well, I think the worst case scenario for gold is actually that it remains in a commodity type channel tied to the price of oil. Sometimes it'll be higher, sometimes it'll be lower. Of course, the best case scenario for gold is the revaluation that would result from it resuming its monetary role. Now, as far as its connection with natural gas, I've actually taken a look at that in the past and have only ended up frustrating myself when I've tried to make a connection. And the reason is that natural gas is a very different type of energy source than oil. It's not nearly as fungible because it's a very local phenomena. You'll find that the price of natural gas in Europe is very, very different from the price of natural gas in North America and other parts of the world. Yeah, and that's because there's a bit of a transportation problem, isn't there?
Well, they're working on that, I would say.
Yeah, but you mentioned the cost of North Sea oil, and I think there's a related phenomena with natural gas. I mean, certainly you can make natural gas perform like a liquid fuel, but doing so is very costly. There's a big capital cost involved in that, and a big energy cost involved in providing the amount of refrigeration required to liquefy the natural gas.
Okay, well, let me hypothesize. Let me suggest to you, based on history in the 70s, at the start of the 70s, the North Sea oil for the British, they just couldn't get it out. It was too deep.
Mm-hmm.
Technology didn't exist. By the end of the 70s, by the 1980s, the budget for research and development for the oil companies was greater than the budget NASA had available to put a man on the moon. So what you saw was a great increase in the value of oil, which was a decrease in the value of money, and that justified the allocation of greater resources to getting marginal oils out at higher cost. Now, jump forward to the present, and if we were to sort of say, well, gold is going to go up in prices, which is our underlying thesis here, and if I was to hypothesize that gold is going to go up in price, and also oil and natural gas are going to go up in price too, well, in those circumstances, they become currencies, albeit they're more commodity-like. But, oil, black gold, nat gas, when the pipeline politics is done and the pipelines exist, and after all, what is this Ukraine, invasion all about? If it's not pipeline politics, I'm a Dutchman, and I'm not from the Netherlands, I'll assure listeners. So here's my point, that I think we're about to see a great revaluation after the technical difficulties with nat gas have been surmounted, and I think possibly we're going to see a a new development in the, I mean, the Gulf oil spill was deep oil drilling. I think we're going to see more deep oil drilling with greater or superior technology and safeguards. And I think all of that's going to come from the crash of the Western currencies.
Yeah, it very well could. I think the future of the energy markets is extremely critical. Gold and silver and oil and natural gas, I think, are the most interesting things to study. And I agree with you that energy has, for a long time, been far too cheap. And the reason why I say that is if you look at oil, for example, not in terms of dollars, but in terms of energy return on energy invested. Many years ago, in the 20th century, the return on the energy return on energy invested was about 100 to 1. So when you took into consideration the amount of capital that you needed to put on the ground and the energy required to produce that capital,
yep,
and the energy required, for example, to bring the oil out of the ground, it was about 100 to 1. Recently, when we started taking a look more at offshore drilling, where you require a lot more capital and a lot more energy to release the oil, we've been looking at energy rates of return on energy invested of maybe 20 to 30 to 1. And recently, we've started getting involved in all this fracking and shale oil and pressurized wells where we pressurize with CO2 and nitrogen. And we're starting to get down into the single digits and, in fact, the low single digits. The concern that I have about that is that as we approach 1 to 1, that's basically end game, and it won't matter how high the price of energy becomes. It just won't be worth it to take it out of the ground. A lot of these fields will just not be economic because it requires so much energy to release the energy that's available, and that's a big potential problem.
Western society is going to have to learn to live a bit different. Okay, can we change the subject slightly, Paul? I'd like to
Sure.
jump back. I'm going to go back into the Freegold thesis one more time, if you don't mind. It has always been one of my lingering thoughts, one of my little problems with the Freegold idea, which was that gold was a pure central banker's reserve currency, and therefore would it. I think the figure they had was $50,000, but I'm sure that's been revalued to some different figure, given both the expansion of credit instruments and derivatives, and also the collapse of others of same. And as the bond markets pulsate and swell and decay, we're going to see new figures for the valuation or proposed valuation of gold emerge as the amount of credit and debt varies, or to put another way, how much they write off and how much they try to inflate away. But one of the central planks behind this whole thing of the free gold as a currency and being revalued has been the notion, or the original concept, that behind the scenes gold is being traded by central bankers in large quantity, in reserve quantity, i.e. tonnage, at a higher price than gold is being transacted on the retail market. Now, it's a nice idea, and it has formed a central plank of the FOA, another thesis. And we're not exactly going in there with where you're coming from, because you're thinking of oil as a petrodollar exchange asset and financing asset, and the debt in relation to it, which I actually kind of warm to that interpretation very well. But looking at the other side, I'm certainly not going to dismiss what they say, but one of their problems in my eyes has always been the fact that gold in large quantities is being sold behind the scenes at a higher price than gold on the street. Now, let's just set aside premiums for small quantities of gold in the local coin shop, and can we examine that issue, please?
Yeah, that's the duality of the gold price question, right?
Yes, yes.
I don't personally believe, or at least I don't see any evidence that there actually is a duality of price. That the price is the price. You go to your local coin shop, you can buy an ounce of gold for $1,350, $1,400, I can go to the coin store and do the same, and the offer that they would have if we wanted to go there and sell an ounce of gold would be slightly less. So, gold does change hands at the officially broadcast price that's determined by the futures markets. That's the price. Now, that doesn't mean that everybody values their gold the same way. Price is set on the margin. It's the people who are willing to come together and make a trade. And when you take a look at the amount of physical gold in the world, we have about 1 billion ounces total that are held by the central authorities of the world. And we have about 4 billion ounces of gold that are held by everyone else. So it's not really a central banker's asset. They only control about 20% of the total above ground stock. But if I were to come to you and say, I would like to buy all of your gold, would you be willing to sell it to me all at the current price? Well, if you're a gold buyer, probably not, because the only reason why you're buying is that you think that it's worth more.
So what you're saying is that a large quantity of gold justifies a higher price because it has been intelligently acquired.
Well, I think the large quantity of above-ground gold that's not being sold is evidence that people are using it as a store of value. And I would argue that the people that own it basically value it much higher than what's ever seen on the market. Because remember, only about 1.5% to 2% of the gold in a given year is basically sold. That's 2% of the total above ground stock. The rest of it doesn't move. And the gold that's being sold is being sold by the mines. And the executives of these mining companies, they don't care, basically about the value of the gold that they're selling. They're in business to make a paper profit. And so if they can pull an ounce of gold out of the ground and sell it for 30, 40% more than their cost of mining that ounce and refining it, they're going to do that. And since price is set at the margin, that's going to be the price, and it's going to be largely a commodity price.
This is the big point you're making here, because what you're saying here is opposite to what many people say in the media. Namely, people point to a large above-ground supply of gold relative to the amount of gold bought and sold, and they say a rise in the price of gold or a fall in the price of gold is going to provoke all this mountain of gold to come on the market, and the price of gold will collapse. That is to say, all this gold is a liability. But you're making the point, which is that the new gold is what's going on the market, being freshly mined, and the gold which is above ground, which is 80% of it or 90% of it is not in the central bank hands. You're saying that is an indication of gold which no one will sell, and therefore it is an indication of demand for more gold, which has just not been filled yet. So you're actually saying all that above ground gold is a positive thing. Now, you are opposite to some commentators I've seen on this, and I like the point you're making, and I wish you'd kind of elaborate on this.
Oh, yes. Well, a very large above-ground stock, I think, is actually a positive for gold. If you take a look at the classic characteristics of money, one of it has to be stability of value, right? And the only way that you can really have stability and value is for the above-ground stock of something to be much, much greater than the amount that can be created in any given year. So having a 5 billion ounce above ground stock that doesn't move is a big positive for gold because it provides stability and value. If the mines were able to produce twice as much gold as they were last year, there would be ready buyers willing to accept it. And one of the reasons why they would be willing to accept it is gold also has, unlike a lot of other commodities, something called constant marginal utility, or at least near constant marginal utility. I'm sorry?
Will you explain that for the listeners, please?
Sure. Put simply, if I decide that I want to buy a hammer, for example, right? I buy one hammer, it has a certain value to me. Do I have a reason to go out and buy another hammer? Well, maybe, but there's only so many hammers that I'm going to keep in my workshop, right? Okay. Go a little bit further out the scale and take a look at certain food items like bananas. Because bananas tend not to last very long, you really only have a demand for a certain number of bananas in any given week. I mean, you buy more than six or so, and you're really doing yourself a disservice. So things like hammers, bananas, many other commodities have what's called rapidly declining marginal utility.
Okay.
Now, you take a look at something like gold, for example. It's on the exact opposite end of the spectrum. It maintains its purchasing power. It does not decline in marginal utility. If I have 1,000 ounces, for example, I will value the next 10 ounces that I've acquired, that I could acquire, as much as I value the first 10 ounces. They do the exact same job for me.
A very good point.
Yeah, and the very large above ground stock is evidence of the fact that gold is hoarded, which means that the majority of people in the world basically have voted with their wallets and have decided to hold this gold.
This makes nonsense of what many commentators say about the above ground stock of gold, and I like what I'm hearing from you here, Paul. So, sorry, please continue.
Sure. There's an old saying by Upton Sinclair that says, it's amazing what people don't understand until you realize that their salary depends on them not understanding it. Right? So I'd argue that many people in the financial world are in that position. But going back to the theory, you consider the 5 billion ounces of above ground gold that do not move, and the current price of gold, which is over $1,000 per ounce, and you realize just how much pent-up value there is associated with this gold. And you would have to conclude that the people that own it are either complete fools for doing so, or they value it very highly. And I happen to be of the second camp. And so the very large above ground stocks, I think, is a great positive for gold, and is a testimony to the fact that people view it as something that has value and has constant marginal utility. And because of this constant marginal utility, you would have to conclude that there will always be a market for it. Whenever the supply of it expands, there will always be willing buyers. That's what makes it the perfect money and the perfect store of value. And coincidentally, that's also why I decided to choose smog as my icon, because I think the central thesis that I have behind gold really revolves much around the fact that it's the most hoardable commodity that there is.
Yeah, you have an excellent point there, and I'm delighted to hear somebody so clearly turn the conventional wisdom on its head. Well, is it wisdom? It's certainly not. But the conventionally promoted idea about gold as the above ground gold stock as being a liability. Truth of the matter is, it's only a liability when central banks try to sell it in an organized fashion, and they can't do that forever.
Yeah, and I think you'll find, if you take a look at the threats of central bank sales, if you go back in history and look at all those threats, you'll find out that they were just that, threats. And
most of the threats were made at the end of the selling too. Most of the threats were made just about the time they ran out of gold to sell.
Yeah.
I find that interesting.
But they can be very effective at manipulating the Western traders who think that the announcements are important, right? I mean, take a look at price movements nowadays. A lot of them are the result of computers that are interpreting language and speeches, right?
Well, they always like to tell you they have more gold than they have, and they like to exaggerate the powers they have. There is no question about this in my mind. For example, we see, I don't know, in the Netherlands they're talking about we don't need so much gold for central banking, and next thing you find that some of the banks in the Netherlands are defaulting upon the gold accounts of their clients. Well, you know what, that doesn't really confirm what the central bank was saying, does it? And you also see times like when the IMF were talking about selling their gold, and gold was no longer going to be a reserve asset, and gold was no longer going to be money. And they were finished with gold, and it was going to be SDRs, and it was all they could create it out of thin air, and that would suit them nicely, which I'm sure it would. Bankers always like something that they own all of it, and they own the ability to create more of it. But when the IMF said they were going to sell, was it 200 tons of gold, and the Bank of India just turned up and said, yeah, thank you very much, we'll buy that. They went, actually, well, maybe not. I believe the Indian bank got some. but I can tell you that half of that offer was welched on. Was it the BIS or was it the IMF? I think it was the IMF.
It was the IMF.
Yeah.
I think the BIS is in a very, very different position. It's very interesting. Since 1999, I think they've been telegraphing the fact that Europe wants gold very much to be more a part of the monetary system. I think that Europe is really trying to undermine the petrodollar right now, and they've been waiting for their opportunity to do so. They just want to have something ready to go, once the petrodollar is jettisoned. The Euro project has really been a project that's been evolving since the 1970s, and the architects have been very patient. But something very important happened in 1999, and that was the central bank gold agreement.
Oh, yeah, the Washington Agreement, yeah?
Yeah, this was the Washington Accord, and if you take a look at the announcement, there's some very special things in there. One, they limited sales to the ones that had already been negotiated. They said specifically that they view gold as a very important part of the monetary system. And most importantly, they said that they would no longer be increasing gold leases. So this was basically a shot across. This was a shot across the bow that said that they were starting to withdraw support from the paper derivatives market that I had mentioned early on that they are using for funding oil purchases. This is the arrangement between the bullion banks and the gold mines. So the European banks, which account for 40% of central bank reserves, basically withdrew their support. And every 5 years, they've been renewing the agreement. In fact, in 2004, they put together essentially the same agreement. And then in 2009, they renewed it again. However, in 2009, it's quite interesting. They removed the language about the increased gold leases. Now, I'm not sure exactly why they did that, but it's very interesting that the past 5 years where the agreement did not say anything about limiting gold leasing resulted in a period of weakness for gold and silver. Now, the agreement is due to be renewed again at the end of this year, so it should be quite interesting to see what kind of language is included in that.
Yeah, a little bit of realpolitik going on there. But I do think we'll find the reserves, a lot of the reserves are not theirs anymore, and it remains to be seen when in many cases 5-year leases roll over, whether they get them back. There must be compliance officers within central banks who are rather concerned at the liquidity and robustness of the bullion banks to which this gold has been leased, as to whether they'll ever see it again. But in many cases, force majeure would apply. If gold was leased and it stayed, for example, in the Bank of England's vaults, and it was leased to, for example, Barclays or Deutsche Bank, and if that gold was then sold into the market and sold and rehypothecated and sold and leased and sold, so long as it is still in custodial care within the Bank of England's vault, a lot of those contracts can be broken by sovereign force. So I would think that maybe some of the alarmists' views on central bank gold being gone are probably ill-advised, because the central banks in many cases can just say, with the sign of a pen and a new law going through, it's all ours again. And I wonder, just quantifying this, how much is which, how much is available, how much is rehypothecated. But I suspect that in many cases the rehypothecated gold is still there. Now, gold which has been, let's say, acquired from other sources than sovereigns, this does not apply to. I think
that's right.
They'll be lucky to see it again.
Yeah, I tend to agree with you. I know there are a lot of people who are very upset and say that the gold isn't there, but I view it from a slightly different standpoint, and that is that it's in their best interest to keep their gold in their possession. Sure, there are going to be people on the inside who might lend their name to these gold loans and backstop them, for example, just to keep the oil flowing to where it needs to flow. And certainly they may lend it out on paper, but I think that the old adage that possession is 9/10 of the law basically applies here, that they will keep tight custody over where the gold is actually stored. And while they may not be free to move it or change title to it because it is encumbered, I think the evidence that the gold is actually not there is a little bit lacking at the moment. And we can certainly speculate on it, but I suspect that it's mostly there. If any has been moved at all, I think that the confidence that the planners have that they'll be able to get it back is pretty high.
Indeed. Paul, I think we're on for quite a period at the moment, and maybe we should wind it up. But certainly, I do believe there's room to come back and cover more ideas here. Can I ask you to tell the listeners, a little bit about your YouTube channel and where they can find out more and where they can see your excellent videos, which are free?
Sure. Oh, sure. Yeah, it's a small YouTube channel. I've been putting it together. It's been around for a little under a year. I think I have about 80 videos up there at this point. It's mostly just 10-minute commentaries to provide my observation of the markets, and provide a little bit of theory that I've picked up over the past 10 or 15 years of study, and it's there for free. And if anybody would like to check it out, the channel is Belangp on YouTube, and I'd appreciate any comments that any of you might have after viewing any of those videos, because I think that a lot of the value that we've gotten out of this channel is that the community has been able to exchange a lot of very good ideas.
And I would add to that, I wholeheartedly recommend his work. If you haven't seen it, go and see it before doing anything else. This is one of the few sources of high quality work on the supply and demand of gold, and it's out there and available, and I just recommend it completely. Now, I'd like to thank you very much for spending so much time here, Paul. I mean, it's very generous of you. And
well, I'd like to thank you. I'm flattered.
You are definitely much more on the supply and demand side than myself, and it's very refreshing to hear a clear voice on this subject, and thanks again.
Well, thank you. I've enjoyed it.
And with that, we'll wind it up. Thanks to everyone for listening, and I certainly hope you enjoyed this discussion. And we'll post it I think we'll post it two ways. I think we'll have it on Belank's channel in YouTube, and we'll also have it on TFM for our listeners. And thank you all. Bye bye now.